Welcome to the Multifamily Investor Nation podcast. I'm your host, Whitney Elkins Hutton, the Director of Investor Education here at PassiveInvesting.com. And today I'm joined with Charles Carillo. Charles, welcome to the show.
Thank you so much for having me on, Whitney. It's great to be here.
Excellent, excellent. Well, before we dive into the details of 6500 South, 536 units in Dallas, Texas, tell us a little bit about yourself, how you got started in multifamily real estate and where you're at today.
Yeah, so I, in quick 60 seconds, I'm originally from a small town in Connecticut, and my dad had been a multifamily investor since 1984. When I got out of college in 2006, I purchased my first multifamily property, which was actually what we call now a house hack. So I lived in one of the units and rented out the other two. Then in 2008, I bought another 3-family, and then in 2009, I bought my first commercial property, which was like 40 units of residential mixed use. Then bought some other properties. I moved to Florida in 2012. Put those all under third-party management, which I sold that whole portfolio in 2022. And over the last, I would say, 7 years, we've been involved with syndications. And where I'm located now is in South Florida. And our focus market-wise is Dallas, Greater Atlanta, and then we call the I-4 corridor through Florida, which is Jacksonville to Tampa.
Oh, very cool. Very interesting. Well, let's talk about 6500 South, 536 units in Dallas, Texas. Let's start off. When did you close the deal and what was the purchase price?
We closed this a day before Thanksgiving, and the purchase price was $58,685,000, and we had negotiated down a little bit from there, so it was at $109,400 a unit.
Well, happy Thanksgiving to you. Have that off the plate before the holidays. Well, let's back up the timeline a little bit. How did you find the deal? Was it like on market? Did you use a broker? Like, how did that all go down?
So one of my partners found the deal. This is their 13th deal in this market, if I remember correctly. And this is from one of their brokers that they have a very good relationship with. So we had everything sent out. We kind of were reviewing it a little bit, and we thought it was a screaming deal. And the group that we purchased from purchased it back in 2017. And this is kind of what we were looking for, because we knew with interest rates going up and anything like this, we weren't really planning on buying anything that had been purchased in probably the last 12 months with where everything was with the market. So this is great finding this deal, purchased in 2017 from this group. They put about $5 million into it. And what's interesting about this property is they put that $5 million into mainly the exterior of the property. It looked beautiful. A lot of the amenities were all done over. Roofs were all done over. There's like 37 buildings in this property. So it's fantastic. It was great getting into it. The one thing was that this property was built in 1985, and the units in the interior were very classic, which is fantastic for us as value add operators, because we're able to, that's where we can go in there, and that's where we're actually getting those rent increases.
Awesome. So the overarching business plan, it sounds like here, was updating the interior units. Well, okay. So when did you find the deal? You closed in November, but what did you find it like in July, June? Like when did the whole ball start rolling here?
Yeah, so our first term sheet came from our what we were working on, going through numbers and figuring out exactly what we're doing in August of 2022, and we found this right at the beginning of that month. So it was something that going back and forth, figuring out exactly what we could get it, because rates were just continually changing, as everybody knows, through this time. So what we were getting in 1 month was a little different the other month, and that helped when at the time that we put it under contract. From the time that we actually closed on it, we were able to get a little bit of a credit back from the seller. And that was also for that. And then also for a couple items when we went through due diligence.
Well, before we get to the due diligence piece and talking about lending, let's get through how you structure the offer. So okay. Was there competition on this deal? Were there other people looking at it?
Yeah, so there were other offers. This was a pocket listing from the broker, and they had a whisper price, and it was right around 60. So it's like 61. So because we initially had went under contract just under 61. It was like 60,500,000. And when we were going back and forth with the brokers on it, they were telling us they had another interested party, and there's actually one other one as well, which completely got backed out right away because of the financing situation. And they were like, we don't know, like it just, everything, just went so fast with those interest rate hikes. So we had that. And then the other one that was, there was other ones that they weren't really serious, I would say. We had two that were really serious that we were competing with, and then they backed out as well. at that point, when we put in a little higher of an offer, and I think they came in like around 57, 58, because of the whole financing piece, they weren't sure. And we ended up closing just under $59 million on the deal. But it was, we just had people kick out because that were fighting for the deal because of interest rates. I think that's what we've kind of brought it to.
Okay. So how did you structure the purchase sale agreement? What was the timelines there for like due diligence, closing? Did you have any extensions in there?
Yeah, we had an extension because we were supposed to close at the beginning of November, and it was just financing was just dragging its feet between going from because I believe we had a rate increase right around that time. So it was pushing it out from actually the final term sheet to where we actually ended up closing. And it worked fine for us. I didn't think this was going to close in November. Obviously, we just said like right before Thanksgiving, I didn't think anything was going to close. I'm always hesitant about this 45 days between Thanksgiving and Christmas. And it's like one of the things was that when we were looking at the deal and when we were setting up the time frame from it, we did a 60 days. And then we had set up that do our inspections over a 15-day period. And that's what we did. We walked it. It was one of my partners walked it. I didn't physically walk the property. And then our two main operators that were on the ground there walked it with our property management company, which was their in-house. So it's their company.
Okay. So during that 15-day due diligence, did you guys tour the property before, or did you guys just do the unit by unit walk like in that 15-day period?
That's a great question. Briefly toured it. And just going through a lot of the common areas and through a couple of their vacant apartments, but nothing really in depth. And that allowed us to put in pretty strong offer for the seller that they really liked that. And we got a really good price on the property. I thought like, where we ended up at 100, just under 110, I thought this property would probably have sold a year and a half before for like 120, maybe a little bit more because of the area that's it's in. Yeah. It's in an area just southwest of Dallas, of like downtown Dallas. And so it was when we had gone through everything and when we were working with them and we were looking through everything, the thing that really stuck out to us when we did the final due diligence walkthrough, the final inspection, was that we had a lot of mechanicals that were older than was stated. So when they were doing their renovations, they were just kind of doing a lot of the exterior. And then at that point, what they had said was that they want to be out within I think it was like 5 or they wouldn't be less than 6 years or something in this deal for their investors. So that was kind of pushing them for going through with it and kind of moving forward with the deal as we were and giving us a little discount, but they hadn't completely finished the property. Obviously the interiors weren't touched, but they hadn't finished some mechanicals that had issues in it. And we were finding a number of HVAC units that were just kind of like on their last leg, and then hot water units as well. So that was one thing that we saw that came up that allowed us to go back and confidently, retrade a little bit. And it wasn't a major retrading. We went down probably $1,500 a unit, but it was something. And add it with the interest rates, it allowed us to secure that price.
Got it. And then what kind of earnest money did you put down on this property, and when did it go hard?
We put 1%, and then we put an initial 1% down on the property as well after our inspection period. So it was 2% we put down totally.
Okay. And then was that pre-funded by investors, or was that something that the general partnership put up?
General partners put that up.
Awesome. Okay. All right. So we talked a little bit about the physical due diligence. What came up on the financial due diligence?
So financial due diligence was that we were finding more apartments than were said that were vacant. And I don't think it was anything that they were trying to pull over us. I think that just because of their management that was with the property, they weren't as detailed and as they didn't really know 100% what was happening with some of the units. So when we were looking through and doing our physical due diligence of the units, which was, not matching up 100% with the paperwork. And then we also had when we took over the property, we were actually doing the same thing, making sure that everything lined up and getting credits if there was any issues. But we didn't really have any issues at that point during the closing part of it. But when we were doing our physical due diligence, we realized a couple of their vendors were pretty expensive too. And that was something that we had looked at that we didn't know exactly that it would have been that much of a spread from us. And then their management was a little higher because our management on this for the in-house operator is like 3%, and they were paying just over that as well. So there was a few things as we dug into it, going through all the paperwork and all the different leases. We found some units that were actual vacant, that people weren't living in there per se, and that the management company, I guess it was a transitional part of it. They didn't really know. We didn't really get a clear answer on that. So,
I
but
got keys to an apartment, but I don't know if somebody's living there or not. Interesting.
and that's a mix with with apartments. And I find this with people, the older they've owned or longer they've owned the property, the more that they're like, someone, now it's like their brother. Oh yeah, I know that person, but they're like, not this person. It's like my brother-in-law, you know what I mean? That like signed on it. So going through, and then it was like, okay, so now we have to like grade this lease a little lower because it's something where it's not even the same person there. Maybe they're still paying rent. We're told they're paid rent, but if they don't even know the person that's in there, I mean, how do we, so that was just something that we were just putting a little bit more money into reserves for that, because we were like, okay, when we found these units coming up, that's what we found. We were like, okay, this could be an issue going forward, which really hasn't been that way. So we were lucky to find that it was, we were able to re-sign most people when they were coming up. Anybody that didn't have a lease, we were able to stagger their lease while we were doing our renovations, because this property is currently about 8 to 9% vacant as we're going through our units.
Got it. Okay. So you had a little bit of economic vacancy. You had some lease audit during the lease audit, things that weren't exactly lining up. You had the HVAC, HVACs and water heaters that you uncovered upon due diligence. And so all of that, it sounds like you got to get a little bit of price reduction, about $1,500 a unit. So that brings us to the financing. All right. Now you got your final price. It is fall of 2022. Sounded like, at least before the show when we were chatting, that you had multiple term sheets that you were going through. So tell us what kind of financing you landed on with the deal, but also what was that journey like for that 4 months that you had it under contract?
It was just very difficult when we were, from the time that we started, from the time that we actually closed. So we saw the cap rate increase by like 0.5% during this time as well, because they were still renovating units, and they were still renovating some of the exteriors and putting in new people. Let's just say they were kind of fixing some issues that they knew were present, and since it's kind of dragged down a little longer than they expected, because they were planning on selling this in earlier in the fall of 2022. So they were like, working on it, and the property actually increased in value during this time of what it was. But the thing though is that what we had found was that what we're financing that we actually went on was that we had a floating rate program through Freddie that was 65% loan to value, 4.95%, and a 2-year rate cap with a 10-year term, and then yield maintenance that was for 2 years, and then after that a 1% prepayment penalty. So we thought was a pretty fair price, and we thought we were pretty much through the majority of the rate increase at that time, which was true. I mean, there's been a few more, but this property still could be refinanced somewhere just higher than what we have it now. So it really wasn't. We were pretty lucky for closing at that point. I think that made it less risky for us, I think you'd say. I think we'd want to go on a lower price if we had done it closed earlier with what was happening. And I think that's what scared those other 2 buyers off.
Got it. Now, since it is a floating rate loan and it is a value add strategy, I'm curious to understand, is your lender currently escrowing for the next rate cap, or how is that working?
Yeah, that was one thing that, great question. I can, so I was actually looking at this beforehand, and they initially said that the rate cap would be for a minimum initial term of 3 years based above what our strike rate was. But they said that it would be analyzed. They would analyze, and then they would start escrowing for another 2-year rate cap at this point. So, which is fine. It's not a problem. And I believe we put the majority of that money already up. It was already in reserves when we closed, but it was just something that they were asking because it was initially 3 years, and then they agreed because the price between 2 and 3 years on the cap is, as you know, very expensive. So we stayed with 2 years, and I think that was a wise decision for where we are right now, because we have that 2 years where we're not going to want to refinance at all anyway because of the yield maintenance, but going after that, just a prepayment penalty of 1% after that. So that gives us a lot of leeway. So maybe our rate goes up 25, 50 basis points, but it's not going to go up. If our rates go up another 0.5% from here, it's not going to, it's not going to dramatically change the cash flow of the property.
Okay, so let's talk about the other part of the capital stack, which is the raise. You raised money on this deal. So what was your total raise? And how did you work with your limited partners, and how did you work with your general partners on the deal?
Yeah, so we raised $25 million, and we had we had three sets, I guess you would say, class sets for limited partners. And so we had one that was our class A, which was really our preferred equity, and that was a 12% preferred paid monthly. And then we had a class B at 9% preferred equity, and that was more of your typical when we're going to go do it was a split of a 75-25 on that one. And then we had our class C, which was the 70-30, and that was an 8% preferred return there. And that was for smaller investors coming in with $50,000, which we initially done 75. We moved it to 50 because we had a number of investors that wanted to come in with a little bit less at the end. So that's initially how we had it set up. And we had done about 15% it was just under 15% that was preferred equity, and the rest of it was common equity, which would be that class B and class C.
Got it. Were there any IRR hurdles or anything like this, or was it just like the first hurdle was the pref and then just straight splits after that?
We were doing the pref and then the split after. That's correct.
Okay, and then what kind of fees were charged to the deal?
So we had a fees initially. I'll pull up the whole list here. So there was a few different things of how we did a 2% acquisition fee. We had a 1.5% origination fee. Well, that was from lender. And then we had 0.5% we put away for title and other costs. So we had initially 4% in costs initially going forward. And then as the deal was running, we had our 3% management fee for our in-house management, and then 2% for the asset management fee, and then a one-time 2% acquisition fee. And then we didn't charge, or we haven't charged it yet if we did, but there's no disposition or refinance fee in this deal.
Okay. Well, you've been very open and concise with your details. So I just really have two questions left for you. What did you find easy during this deal that you thought was going to be more challenging? And then what was something that was a little harder than you expected that you thought would have been easier during this deal?
Harder is easy, and that was raising money for this deal. It was we had a lot of distribution. We had a lot of what am I saying? We had a lot of tax. We had a lot of tax perks for investors coming in there, and our depreciation was, I want to say, it was like almost 60%. So it was great for investors coming in, and I thought that would be a huge selling point. Where everything was in the market and everything was going on, it wasn't as big of a selling point as I thought. So it took, it took some time. We were raising all the way up into the beginning of November on some of the deals, and one of my partners came through with a few larger investors that really just, we finalized everything, and the GPs put in an extra, I think it was like $500,000 at the end to close it. But it was a very difficult time to raise, as it is now in 2023. But it was a difficult time to raise, much different than us with it. We had a deal that we closed on earlier in 2022, which was very easy. But I thought that what was harder, that was easier. I thought we were going to have more pushback on doing the retrade, to be honest with you. I thought that getting that extra couple $1,000s off was going to be a little bit more difficult with the sellers. But since they had they had made so much money on this deal where they are now, so much value had increased on it. I think at that point, they're much easier to say, okay, we're going to wipe our hands of this, and we'll sell it what it was. And they understood about people that had fallen out, and they understood about this rapid increase we had, unforeseen, let's say, of a rapid increase in interest rates. So those two things put together made it easier, because I didn't even think we would get the deal initially.
Thank you so much for sharing. Well, Charles, if people want to find out more about you, how can they do so?
Yeah, if you're interested in learning more about our firm and the deals that we commonly work with, you can go to our firm, which is harborsidepartners.com. And on harborsidepartners.com, there's a lot of information. I have a twice weekly podcast. Whitney has definitely been on there before, and a lot of information, a lot of free guides. And if you're interested in investing, you fill out the short investor form, and we'd love to speak to you.
Awesome. Well, again, Charles, thank you so much for sharing your knowledge and insights with us here today. And we look forward to hearing about your future deals.
Thank you very much.